Hey everyone, I'm Tom Gentile, America's #1 pattern trader here from patternsandprofits.com. And today I want to show you how to build an Iron Condor very quickly and very easily using this hub platform. So 3 things you need in order to build this or anything on the platform. You need a chart of the asset you want, you need the actual option tables themselves, and you need the strategy, which in this case is going to be the Iron Condor. So what you're looking at here is a chart of Apple, along with my target of between 320 on the screen, 310, 320. I also have the July options down here, 72 days to expiration, and everything is ready to go. Now, watch how fast this works. I'm going to click on the word select strategy right here in the middle, and I'm going to go to Iron Condor. And when I do, voila, the Condor actually shows up on the screen for me in both the option tables and the option details. Now, this Condor is a delta neutral Condor. What that basically means is it's surrounding the strike price, so it's non-directional. And so you can see that by simply going in and clicking on the risk curve. And I'm going to click on the risk curve right now, and it's going to bring the Condor up right into view. So as I pull this down, where you can see current price of Apple, you can also see the Condor. Okay, here is the long put on this side. Here is the long call on this on the upside. These are there to reduce the risk. The money is made on an Iron Condor in between the short call and the short put. So what happens is you basically have a call credit spread and a put credit spread. And if the asset itself falls in between the call credit spread and the put credit spread, you get the credit on both sides. That's why it's called an Iron Condor. All right, 4-legged trade, and you can see that right here. But what happens if Apple goes to my target by July? Well, if it goes to my target by July, I could be right on the price, but the problem is that my target's way up here. Look at the risk curve. It would actually lose money if it went to my target. So what I need to do is I need to be able to take this Condor and move it up here and surround my target price, not today's price. That's what makes it a directional Condor. So for that, what I'm looking at is I'm looking at, for instance, instead of if you look at the details here, where I've got a 275, 280, 290, 295 spread, I need to move these up where 310 and 320, somewhere above 300 is where I want to be. I want to be right around 315 area for my Condor. So in order to do that, I can simply go in here and I can change these strikes up. As you can see, I can change any of these strikes by clicking on them and putting a new strike in place. I can leave the expirations alone. I can even leave the quantities alone. Just change the strike prices on the calls and the puts. So I've done that in this example. And what I've done is I've taken that non-directional Condor and I've put the 290, the 300, the 310, and the 320 on here, right? But if I want my sweet spot to be 315, then what I'm selling and what I'm buying, what I'm selling on the put side, what I'm selling on the call side need to be at the 310, 320 strikes. So I'm going to change this one more time. So the put at the bottom is going to be the 300 strike, right? The put that I'm selling is going to be the 310 strike. The call that I'm selling needs to be 320. And then the call, let me set that 320 up there. And the call that I'm buying, well, that needs to be at 330. Now take a look at the risk graph above and you can see what's happened here. Now what I've done is I've set that up where my target, which is right here, is right in between the 320 and 330 calls. So now I'm flanking this projection with both a put credit spread and a call credit spread. Let's take a look and see what the risk and rewards are on this. So this trade right here looks like it gives me a net credit of $890 if I could do it at that price. This is a spread. If you notice, it's a 10-point spread between strikes. So what you're doing is you're taking what you receive. You take 1,000 away from that because that's 10 points times 100. And you're talking about something that's very close It's above an 8-to-1 reward to risk ratio. What has to happen? Well, Apple, the stock in question, has to come up and meet your Condor strike. It needs to come up. In this case, it needs to come up by the July expiration, and it needs to be in between the sell side on both the calls and puts to max profit. My break evens are going to be, again, above the buy strike, but also below the buy strike of both the calls and the puts. So wanted to show you real quick how easy it was to put together a trade like this right there into the Hubb platform. So what we've done is we've taken a simple Condor and we have customized it a bit to match the parameters and our objectives of what we're doing. Thanks for joining me. Hope you enjoyed it. See you on the next one. Bye now.